Good evening, everyone. Thanks for joining another session as part of our option series. So in last 2 weeks, we discussed various terms, we discussed various concepts. Let me quickly review those concepts and then we'll get into the option Greeks and the next set of concepts. And also I'll be showing you some 3-4 tickers which has a good potential to move in this week, along with some just right examples or what are the reasons why we feel like they can move well. Right, last week we discussed about Veru was at $12. Yesterday it moved to $18.5. We discussed about mRNA. On Monday it quickly gave more than 150% in the option calls. We discussed about VRTX. It moved nearly 100% on Monday. So in the same way, we'll discuss few more tickers, few more stocks, which has a good potential for them to move this week. So we discussed about like what is the right, what are options, how these are beneficial when we compare with stocks. What are the merits and demerits, advantages and disadvantages of option contracts when you compare with stocks? For stocks, we need huge investments. With options, with a lower investment, if things go as expected, we can make good money. Now, if the direction is right, if your speculation is right, or to hedge your stocks, we generally use options. Options are basically derivatives of stocks, right? They don't have their own value. But if stock value goes up, your option calls value premiums goes up. If stock value goes down, your option premiums goes down for the calls, right? So they are basically derived from the stock price. And every option contract represents 100 underlying stocks. If you are buying one option contract, that means you are getting into an agreement to buy or sell 100 stocks at a certain price. It is an agreement between buyer and seller where buyer has a right, but there is no obligation. If you're buying something, there is no obligation for you. If you're buying a contract for 950 Tesla, if Tesla goes to 900, you don't have an obligation to buy that stock at 950. If it goes to 1000 or 1050, the seller has an obligation to sell you that stocks at 950, but as a buyer, you don't have the obligation. We discussed about what are call options and put options. When you are bullish about a stock, we buy call options. When you are bearish about a stock, you buy a put option. We discussed about option chain, right? Generally, what all various things are there in an option chain. We looked at different things, right? You have a stock price, all the details here. Then you have the strike price for a stock. That means at what price you are okay to buy it at a future date, right? For example, on 19th August, you want to buy this AM80 stock, which has a huge potential to move. You can buy a 110 contract, you can buy 115 contract, you can buy 120 contract. This is called as the strike price. This side you have calls, you have bid and ask. This side you have puts. We discussed about option chain. You have these are monthlies, right? If you see them in yellow, they are weeklies, generally for next 2 months. Because we are in August, you see the weeklies for August and September. Once September comes, then you will see weeklies for September and October. But for monthlies, generally for next 6 to 9 months, you can see the every third Friday of each month, right? 19th August is the third Friday. 16th September is the third Friday of September, 21st, 16th. So every third Friday of the month, you have the monthly expirations. Whereas weeklies, generally we can see up to this month and the coming month, we can see the weekly options. We also looked at something like option time and sales, right? On the day, what are the various things which happened, right? Who bought, what is the biggest, somebody bought 110 call of 192 quantity for $5. Somebody bought a put of 200 for 2.35. So you can also see that information from this option chain, which will give us some indications, right? There are a lot of calls, 115 call, 119 call, 119 call, 109 call, 110 call. There's a lot of information available in the option chain, which gives us an indication whether this stock can be bullish or this stock can be bearish, right? In addition to this open interest and volume, we discussed open interest is like the number of contracts open for that particular strike price as of that particular day, whereas volume is whatever, how many transactions are performed on that day. So tomorrow or Monday morning at 8:30 a.m., all this will become zero. Whereas open interest will keep on increasing at every day. At the end of the day, whatever is the volume for that day, it gets added to the open interest. Right? Open interest will continue until the expiry date, whereas the volume gets reset on each and every day. So we looked at all those, right? All those things in the last session. What is option chain? We have a strike price, we have expiration, we have monthly contracts, we have weekly contracts, and also we see what is the premium we are paying. Instead of paying $111 or instead of paying 110, what we are doing, we are only paying somewhere in between this price to get into an agreement with the seller, saying like, even though this stock goes to 120 by 19th August, you have to sell me this stock for $111. And suddenly if this stock goes to 115, this premium can become $5 on Monday. Then your investment might be 2.8, that means 28 or $280, but you will make $500 if the stock moves well. Right? We discussed all those things. We also discussed about what is open interest and the volume. And also, we also discussed about in the money, at the money, and OTM, out of the money. What do you mean by in the money, at the money, out of the money? If, right, if the strike price is less than the current stock price, that means all those option contracts are in the money. If the strike price is equal to, right, for example, if the stock price is 110, then 110 will become at the money. Strike price and the stock price should be same. If the strike price is more than the stock price, then in the call side, basically it will be called as OTM, out of the money, right? Out of the money, contracts are generally cheaper, whereas if you have to buy the in the money contracts, they are expensive, right? We also discussed about intrinsic value, extrinsic value. But again, to remind each of you, we discussed about what are in the money calls, at the money call, out of the money calls, or in the money, at the money, out of the money. So whichever is highlighted, they are called as, these are in the money calls, these are in the money puts. We also discussed about buying, right? Generally, you can be a buyer, you can also be a seller. It doesn't mean that you have to be always buy a call or buy a put. You can also sell a call, sell a put. If you think like that stock will go down, either you can buy a put and make money, or you can even sell a call and make money. So you can be on the both sides. It is also called as, if you are buying, then it is basically you are opening a long position, or it is called as B2, buy to open. You are opening a new agreement by buying something. Or if you are selling or you are shorting the option contract, it is basically sell to open. You are selling something and opening a new agreement. So the opposite to buy to open is sell to close. So if you are buying something and opening an agreement, and once the stock price goes up, you will sell it and close the contract. So buy to open and sell to close is the opposite action. If you are selling something, selling a call or selling a put, then buy to close. In some channels you will see B2O or buy to open, right? Sometimes you see buying a contract or buy to open. So you should also know what is buy to open and what is sell to open, or sell to close or buy to close. Then we also discussed about option premium, right? We are paying something. If I am paying some $1.30 to a seller, that means I am getting into an agreement where I am saying that even though this AMAT stock, because they have earnings next week, they can move huge. If this goes to 120 or 130 or 140, you have to sell me at $115. I am paying you this much premium, $1.3 premium, but you have to agree that you have to sell the stock at 115. So by Friday on 19th August, even though stock is 130 or $140, you will receive the stock at 115 if you want to, right, get the assignment of the stocks. If you don't want, then you can basically on Monday, let us say the stock moves to from 110.3 or 110 right, somewhere in between this. If it moves to 112 or 113, this premium can become $3 or so, or $2.5. Or you can immediately sell the contract and you can make the profit. You don't need to buy the stocks. It is not mandatory, right? So we discussed about the option premium will always have intrinsic and extrinsic values, right? You are not just paying this. What is that you are paying? You are paying 1.3 or you are paying 1.6 here. You are paying some 1.95 here. Why you are paying? You are paying for three different reasons. It is not only just for option price. You are also paying for two more things, because based on the time value, based on the implied volatility, you are paying three different things, right? If you are paying some X amount, out of that X amount, divide that X amount into three components. One is you are paying based on the stock price. Second is based on the number of days remaining. It has 6 more days remaining. You are paying some amount for that. For example, if it has 13 days remaining for the same strike price, right? For 115, it is 1.24, between 1.24 and 1.33. For example, 1.3 is the premium you are paying. Whereas here, for same 115, but you have more time here. Instead of 19th August, you have time until 26th August for the stock to move more than 115, but you will pay higher premium. Instead of 1.3, here you are paying nearly $1.95. So not only for the price of the strike price, you are also paying for the time. If you have more time, if you need more time for that stock to move up, you will be paying more bigger premiums. If you want 16 September, for the same 115 contract, you will be paying nearly $3.6. So based on the time, based on the strike price, and also there is something called as implied volatility, right? IV. If you see here, this week, there is a 57% implied volatility. That means, right, there are stocks like AMC, GameStop, right, Bed Bath Beyond. They are so volatile, they can move up so high. Suddenly they can move up. Or if you see properties in Austin or properties in California, they can move so high. So for them, there is a higher implied volatility, right? For a seller, there is a bigger risk, right? If the stocks are more volatile, that means you may pay a small premium and you may make high money, big money. So based on the stock type, based on the implied volatility of that stock from last 1 year, you are also paying some money for the implied volatility. So if you are paying a premium, you are paying it for the price of the stock, you are paying for the time, the amount of time remaining, you are also paying for the implied volatility of the stock. So you have intrinsic value, and your option premium consists of intrinsic and extrinsic. Intrinsic is nothing but the difference between the current stock price and option stock price. So if you see, right, let us use intrinsic and extrinsic. So if it is a 101, the current stock value is 110. 110.38 minus 101, $9.38. There is already an intrinsic value. That means if you buy this contract, you already have some value for that option contract. Whereas this 47 cents you are paying for the implied volatility and time decay. If you are buying a 102 contract, 8.38 already it has the value. That means even stock is not moving at all, you still have this money. You can use this money. You still get back this money. If you are paying somewhere $9, 8.38 you will get back. Let us say stock just sitting there at 102, but you will only lose 64 cents. I hope you got it. Intrinsic value is the difference between the stock price and the strike price. 110.38 minus 101 is 9.38. 110.38 minus 102 is 8.38. You might be getting a doubt like why somebody will buy 101 call or 102 call. I understand if we buy 115, if stock moves to from 110 to 115, we can make some good profits. But why somebody will buy it, you will understand when we say delta concept. And also the other reason is here you are all what you are paying. If it is out of the money call, whatever you are paying for the implied volatility and for the time value. If the stock doesn't move from here, you are losing entire $2.8. But here you are only losing 47 cents. You are only losing 64 cents. If stock stays there, right? If stock is not moving from $110. Here you have a higher loss, here you have a lower loss. So the value, the price value is intrinsic, whereas the time decay or time value plus implied volatility is the extrinsic. I hope everyone is clear with that, right? Extrinsic value is nothing but the sum of implied volatility plus time value. As I told you, for premium, you are paying some money to a seller. One is for the stock price, one is for the implied volatility, one is for the time value. So extrinsic is combination of implied volatility and time value, whereas intrinsic is nothing but the difference between the stock price and the option strike price. And we already discussed about implied volatility, right? The possible move of a stock in a given period. By default, it is 1 year. And that implied volatility is not constant. Today, it may be 57%, right? Generally, before earnings, it will be huge, right? After earnings, AMAT got its earnings on Thursday, right? Coming Thursday afternoon. Once that is done, Friday, you may see this at 30% or 25%, because generally investors are interested to invest before earnings. There is a huge potential for them to move well. So the implied volatility will not be constant always. It will keep on moving. It will be high before earnings and it will generally fall when after the earnings. If you, right, one more thing, I don't know whether you might have noticed or not, you see that there is a value here, plus 6.363, right? 57% is the implied volatility. That means there is a possibility of this stock moving up or down by 57%. There is a huge chances of stock moving up or down. Then there is also a plus or minus 6.36. That means this stock can either go up by 6.36 before 19th August, or it can go down by 6.36 by 19th August. If you add up, right? For example, the stock is 110.38, but let us say it is 110. If you add the premiums of these two, 3.3 plus 2.9, which is approximately $6.3. If you add up the sum of these two premiums, you get the implied volatility, how much the stock can move in that particular week. So here you can see $8. So by 26th August, there is a possibility that the stock can go up by $8 or it can go down by minus $8. So if you add these two values, the premiums here and the premiums here, you can find out this implied volatility for that stock for this period. We also discussed about time decay and time value. If you have more time, then you have to pay more premiums. We discussed about that eBay coupon, or right, a coupon for Best Buy, where if you have more time for expiry, you will expect more money. If you have less time, you will get only less money. In the same way, if it is a lotto trade, you pay very low premiums, the risk is high because you have only one day, same day or same week expiry. If you are buying an option contract for after 2 months or 3 months, you will be paying much huge, because you are also paying for the time. You are taking more time to complete that agreement. So you will be paying more premium. So we discussed about all these concepts in the last week about various definitions, terms, why options compared to stocks, and also we discussed all these things. We also discussed about option Greeks on a high level, right? Let's discuss more in detail. But why these option Greeks are important? Because based on the option Greeks, you can decide which one, right? Which delta you need to take, which theta you need to take based on your risk profile, right? I'll give you an example, but let me explain about delta, and then I will give you an example, right? Why you need to know about this delta or gamma, vega, theta, all these things, right? So what is delta? The delta of an option is a measurement to know how much your option premium will increase or decrease with every $1 move in the stock price. Let's take, right, again, let's go to the option chain so that it might give you a better idea. So from here, I am selecting delta, gamma, theta, and vega. So you can see delta, right, 0.49, gamma 0.04, theta minus 0.15, vega 0.08. You have all these values. Let us say I am buying a $115 call. So what is the delta for $115 call? 33 cents, right? 0.33. That means if stock, let us say I am buying it for $2, right? The premium is 1.91 and 2.02. That means the premium is, I pay somewhere around 1.9596 or approximately $2. Let us say I paid $2 as the premium to get into this contract, to get into this agreement. So that even if the stock moves to 120, 130, the seller should sell the stock at 115 to me. Or if this stock goes to 120, this $2 or $200 can become $500, $600. That is my idea. If stock from 110, let us say the stock price, current price is, let us assume as $110 for easy calculation. So what is the delta here? If I am buying a 115, it is 33 cents. If stock moves from 110 to 111, immediately my premium of $2 will become 2.33. It increases by 33 cents. Whenever stock moves by $1, it increases by, my $2 premium will become 2.33. Suddenly, the stock goes up by $5, right? From 110, it moves to 115. Then delta is 33 cents. So 33 plus 33 plus 33, nearly $1.5. So from $2, it will nearly become $3.6. My premium. So based on every dollar change, if your stock is moving by $1, how much your premiums will change, right? Or if it stock goes down by $1, how much I will lose in the premium? I paid $2. Stock moves from 110 to 109, then immediately my premium will become from $2, it will go to 1.67. So for every dollar change, either up or down, how your premiums are impacted. So now you will understand, if I am very, very bullish about this, right? For example, let us see. If I take AM80 stock, right? Let me see on 30 minutes first, right? I am looking at a 30-minute time frame. There is already, that means for a swing, right? Generally 5 minutes, 10 minutes is mainly for your scalping, day trading. 30 minutes is for a swing where you can hold the position for a few days. So on a 30-minute, it already broke the support. It already broke the resistance here. It broke the resistance here. It is moving up, right? It is looking like positive. It is in the buy zone. It is above the Ichimoku cloud. So there are a lot of positive indicators on the technical side. Then let me also look at the fundamentals, right? Let me see, is there some good news around this stock? One is, I know that there is earnings is there on the Thursday. That means there is a lot of interest for investors to invest into this stock or into this option. You can also see some good news, like if you see so there were some analyst upgrades, and then if you see applied materials chief technology officer, Dr. Om receives IEEE Frederick Phillips Award. And then these shares of all semiconductor and chip companies, right? This is also a chip company like AMD and NVIDIA. It is moving good. Then right, applied materials whale trades. There are a lot of big organizations, institutions placing some huge trades on this. So overall, right, global founders, applied material and Ford to co-host a CEO summit. There are a lot of positive news. If you look at the news side, there is a lot of positive news. If you look at the technical aspect, on the 30-minute, it is looking good. If you see just for 5 minutes, that means how it can move on a Monday. It is right. It is above the support, and it is nearly at the top of the Ichimoku cloud. And if it can break this resistance, it can move another 4-5 points, or another 4-5, right, from 110, it can move to $115. Let's look at the option volume, right? If you see for 19th August, instead of delta, gamma, with theta, let us see what is the open interest, right? How many people are buying calls or puts? If you see, there are nearly a lot of people, right? 3,000 plus open interest on the 110. On 115, there is nearly 1,600 contracts, open contracts. There are 120, there are 433 open contracts. So on the put side, right, to see whether any big institution, generally you have all 3-digit numbers, right? This is giving me one more confirmation. So fundamental news gave me some good news around the company. The technical analysis, right? A lot of it crossed EMS, SMAs. I have a buy. It is above the Ichimoku cloud. If it breaks this resistance, it can move. So it is giving a lot of positive indicators on this side. And then the open interest and volume is giving me a lot of good indicators. There is a lot of volume on Friday. There is a lot of open interest, a lot of contracts. And then I also can look at one more thing to see on Friday, what is the analysis? There were 29,765 calls, whereas 10,016 puts. Right? Another one more confirmation. That means a lot of people are bullish, a lot of organizations are, and how many people are buying between 0 to 20 delta? This 51% bought out of the money contracts. Right? Again, if you remember what is delta theta, if you see, if I go here, delta, this is like 12 cents, 14 cents, 17 cents, 21 cents, 24 cents. This is like 89 cents, 86 cents. That means if the stock moves by $1, I can make 89 cents on every dollar move. Whereas if I buy this contract, 115 contract, I can make 29 cents for every dollar move. So how many people are buying? If you see 81 to 100, nearly 5%, right? Mainly because these are expensive, big institutions, organizations are buying it. 0 to 20 delta, 51% bought it. So there is a huge volume on the calls. A lot of people are buying out of the money, right? 0 to 21. Generally, you are at the money, right? This is approximately at 50 delta. Below that is out of the money. That means all these people who bought this 111, 112, 113 to 120 or more, they are expecting that this stock will move up. So on Friday, 51 plus 16 plus nearly another 10, 80% of the people are buying out of the money call contracts. So there is a huge potential, or 80% of the people are thinking that this stock will move to 115, 120 or more. So there are a lot of indicators from the fundamentals, from the technicals, from the option flow, from the buying point of view. You have a lot of calls compared to puts. So there is definitely a possibility somebody bought 192 contracts, paying $5.10 for each contract, right? There might be a put here, but it is only 200 with a 2.35 as a hedge or something. But there is a bigger call contract. And if you see the overall on that day, there are a lot of calls compared to puts. So you have so many positive indicators to show that this stock can move well in the next week, in the coming week. It is up to you now, right? If I have a low risk tolerance, right? If I buy a 114 or 115 call, I make only 29 cents for every dollar move. If stock moves from 110 to 115, my premium will only go up by $1.5. If I have a high risk tolerance and I have a bigger account, I may go for 101 or 105. So I make more money. For every dollar move, I make, if it moves by a dollar, I make 90 cents. I lose less if it doesn't move. And if it moves more, I make more money. If it goes down also, I can lose more. But if it goes up, I can make more. So if based on our risk tolerance, based on our portfolio size, if you look at the delta, if you are a low risk trader, it is better to buy below 30 or 35 so that you make less money or you lose less money. But if you have a high risk tolerance, right, analysts will try to give it a lower level because they want, everybody may not be able to take a higher, right? If it is a higher premium, everybody may not take it, right? If you see, right, in addition to 1600, you have a 110, you have 3111 open volume. If for 105, there is a 2537. Compared to the out of the money contracts, there is a huge open interest on these ones. That means a lot of people are buying 105, a lot of people are buying 110, a lot of people are buying 115. If you have a big account, maybe buying a 110 is also a good, right? You can make more money if the stock moves up, moves to 115. Or you can even buy 105 call, right? You pay 6.6 out of 6.6. What is the intrinsic value? What is the extrinsic value? If you are buying 105, 5.38, you already have that money. Only 1.17 is what you are paying for the time decay and what you are paying for the implied volatility. Your most of the money is for the stock. So if stock doesn't move, it stays at 110 itself for the entire next week, still you have all this money. Whereas if you are buying a 115 call, all this, there is no intrinsic value. You will lose all this money, all this will become zero. But if you are buying this one, you will, all this value is there. And also, what is the delta for 105, 77 cents. That means every dollar move on the stock, you will make 77 cents. If stock moves from 110 to 115, your $6.5 will become $10. Whereas if you buy a 115 call, you will only make 30 cents per every dollar move. That means $5 move, you make $1.5. Here, if you buy this one, your investment is little more high, but you make $3.5 instead of $1.5. The stock price is just moving by $5, but your price here, your investment is low. So if you lose 30 cents, or if you gain 30 cents for every $1 move. Here, your investment is little more, but you make huge money here. So that's why it is very important for us to understand. Okay, right? Do I have a higher risk tolerance? Do I have a big account? Then I will go with, because, right? Why? Because I have a lot of positive indicators that this stock will move up. And also it shows that there is a lot of open interest here, 2,537, 3,111, 1,600 contracts. All technicals, all fundamentals, everything is showing that this stock can move well, right? Unless there is some sudden bad news. Then it is up to you to take a decision. So the analyst is giving a direction saying like, I feel like it will move to 115 or above. But you can take a decision based on your situation, because they want to consider the small accounts also. So generally they give out of the money calls, where you have a lower investment, but you will also make a less money. But if you buy somewhere here 105, or if you buy 110, you are paying 3.3. Let us take one example. Right? Let us say you have a $100,000 account. $100,000 account. So you have $100,000 portfolio for your options, and you want to invest 5,000 into each position. Now you have three options, right? You have high open interest on these three. You can take 105 call. Again, why you are taking? Because you see all good things. You saw an alert that this AMAT can go high. So you have three options here. You see a lot of volume here, lot of open interest here, lot of open interest here. So your guess can be, these three are the best points or best things to take. So you can buy. You have three options. One is getting a 105 call for 819, 110 call for 819, 115 call for 819. If you want, even you can do 120 call also for 819. So you have an investment of $5,000. So what is the premium for 105? It is approximately, let us say, $6.5. Right? 6.5 is nothing but $650 per contract. 650, because 6.5 is for one stock. We know that every option contract comprises, so 650. Then for 110, it is 3.3. That is $330 for each contract. Then for 115, it is nearly 1.3 and 42 cents, right? 130 and $42. Right? This is for one contract. So with a 5,000 investment, how many contracts you can buy? Approximately, let us say you are buying 8 contracts, right? 8 into 6, because you want to limit your position size to 5%. If it is a 330, how many you are buying a 110 call, then you will buy approximately, let us say 15. If you are buying a 115 call, $130, right? Approximately, let's say some 39. If you're buying a $42, it's like right, so 5,000 divided by $650 equal to $7.6, approximately 8 contracts. Then same 5,000 divided by $330. 330 is for each contract. So okay, 15 contracts. $38.46. Then $42. It is nearly 119. So 119 contracts. So let us see what is the delta for each of these ones. What is the delta for 105? It is approximately, right? 105 got 77 delta, 110 got 53 delta, 77, 53, and then you have 29 and 12. 29 and 12. So now the stock price is 110. If stock moves to 115 on Monday, because of various reasons we discussed, right? You have a 100,000 account and you want to put $5,000 for each position, whichever you are taking. So if you are buying a 105 call value, your investment is $650. So you are buying approximately 8 contracts. So if it moves to 115, that means $5 up from 110 to 115. Then how much you make? Your premium will become each contract 650 plus 77. $727. Here your value will increase by 383. Here your 150 will become 130 will become. So what is the percentage you made here? Right, again, you can multiply this into 8. 727, right? For one contract, your value is 727. You invested 650. By end of the day, the stock moved by $5. So every dollar move, you have 77 cents. So $5 is 5 into 77. 385, 650 plus 385. This is 53 into 5 is like 265. 29 into 5 is 145. 12 into 5 is like 60. So at the end of the day, your 650 is nearly 1,035. Your $330 is like 565 for one contract. Your $130 is like 275. So your investment of 650 increase it to 1,035. That means you nearly made 80% of returns. Whereas if you bought a 120 call, you are 42. I made some mistake. So 77 for $5 move, it is increasing by 5 times, 5 times, 5 times. Delta is 12. Let's ignore this. But basically, right, I hope you're getting my point where if you are very confident, every dollar move you are making nearly 89 cents or 90 cents or 77 cents or 50, right, 53 cents. If you invest low, you will make less money. If you buy a 120 call and if stock moves to 115 also, your premium is only going up by 12 cents, 12 cents, 12 cents. So 42 cents will become approximately 60 cents. But if you buy 105 or 110 call, your premiums will become nearly double, right? If you buy a 101 call, nearly 90 cents. That means every dollar move, you make nearly 90 cents for every dollar move. So based on the delta, if you have a high risk tolerance, you can buy in the money calls. If you have a low risk tolerance, you can buy out of the money calls. You have low risk here. If it goes down, you lose only 30 cents for every dollar going down, you lose only 29 cents. Here, you lose 89 cents. Right? I hope the delta, right? At the money options will always have a delta close to 50 cents. In the money options will have a higher delta, which means they react faster to the movement in the stock. If you buy the in the money, you have a high delta. So you can make huge profits. At the money, generally it is at 50 cents. That means it can go up by 50 or go down by 50. Right? You can also consider this like a probability. 89% chances that stock will be above 101. 86% chances the stock will be above 102 by 19th August. There is a 24% chance out of 100, the stock will be 116. 12% possibility or probability the stock will move above 120. So as probability is going down, your premiums are going down, but you are taking even though you are investing low, the chances of making profits is also low as you go far and far from the in the money calls. So don't go too far assuming that I will only lose 12 cents, but your risk is also high because you have only 12% of chance to make money. If you are buying somewhere here, you have 50% of chance. If you are buying here, you have 90% of chance. So it is important based on your risk tolerance or based on your account size. You can generally, right, around 30 to 40 is the standard. If you are bullish, you take around 30 to 40 delta. But if you have a high account and you are okay to take high risk, you can also buy in the money calls where you make much more huge returns compared to buying out of the money calls. Right? That is about delta, right? So for every dollar move, how your option premiums gets impacted is the delta. If it moves by $5, your premiums goes from 89 cents plus 89 plus 89 plus 89, 4.5. So your $10 premium will become $14.5 premium on Monday. Just I'm reading the question. So that $1 move, it can be up or it can be down. If it goes up, your premium will go up by this much money. If it goes down, your premium value will go down by. So whenever you are buying, right, it can keep changing, right? When you see the next concept, you will understand why the delta will be keep changing. But for now, you understand that when you are buying, for example, on Monday, you buy a $115 contract. Then you might be buying a 0.29 delta. On that day when you are buying, it is 29. After some time, let us say from 110, it moves to 111. The 29 plus you have something called as gamma. This 29 gets added to that, then your delta will become 34 cents. If it moves to from 110, it moves to 112. Then 29 plus 0.5 plus 0.5. Then your delta will become 39 cents. So as the price increases, right, the gamma gets added to the delta. So that's why the delta is not constant. So if you have high confidence about a trade, you can enter in the money calls where you can make a lot of money. If you are low confident or you have a low risk tolerance, you don't want to risk much. Every dollar move, it moves up by this much. Every dollar going down, it goes down by this much. Your premium, whatever premium you are paying. Here also same thing. So based on your risk tolerance, you can take a decision. So one is you are looking at the delta. Second thing is you can also look at the volume and open interest. Okay, here there is a lot of volume. If I'm going out of the money, I will go with this. There is a lot of interest here. There are a lot of liquidation here. That means your bid and ask will be small. You can easily sell. There is not a lot of interest for anybody to buy the 119. If there is a lot of open interest and volume, that means people are ready to buy and sell here. People are ready to buy and sell here. People are ready to buy and sell here. So these 3 points are good points for you to buy a call on Monday based on your account size, right? We already got, if you see, right? We all on Thursday itself, we bought AMAT $115 call. We got it for around $1.45. So, right, Monday is a good time to get $115 if you have a small account. If you have a big account, even $110, or if there is slight retracement, then we can also get this one, right? Yeah, I'll be updating you in the channels, but if anybody not entered, they can get to 115 call or 110 call. Then let's also look about gamma. As I told, an options gamma is a measurement that estimates the rate of change in the options delta. It is like delta of the delta. So what delta is doing, for every dollar move, how much your premium should increase or should decrease. Whereas delta, what it will do, for every delta move, how your premium should change, right? As I told you in the previous example, you are buying a $30, there is a stock which is of $30. You are buying a 30 strike call for $1.5. If stock is moving by $1, so you have a 50 delta. So your premium moved from 1.5 to 2. Now the next dollar, from 31 stock moved to $32. Now instead of moving from 2 to 2.5, it moves to 2.75. You get a 75 cents increase on your premiums. Why? Because you also have something called gamma. That means for first dollar, you got 50 cents. For the second dollar move, you got delta plus gamma. You have a gamma of 25 cents. You have a delta of 50 cents. So for first dollar, you go for first dollar move, you got only 50 cents. Your premium moved by, if you bought 1.5 premium, it moved to $2. Next time when another dollar also stock moves, you got the 50 cents delta, you are also getting another 25 cents gamma. So you also, when you look at the option Greeks, you will also see, okay, if I am buying this 115 call, okay, on the initial dollar move, I make 29 cents. If it moves from 111 to 112, I make 29 plus 5, 34 cents on the second one. Like that, it keeps on going up. As the stock price going up, you will be making, your delta will be changing. You will be making more and more, premiums will be increasing more and more. Then we'll also discuss about another option Greek, which is theta, which is very, very important, right? As I mentioned, theta is a measure of time decay. Your delta and gamma are basically for your stock moves, right? How the stock price is moving. If it is moving up by $1, how much your premium will increase. If the stock is going down by $1, how much your premium will decrease. Whereas gamma is based on the delta. If delta is going up, then your gamma will also keep going up. Your premiums will keep going more higher. Whereas theta is, if you are buying something on Monday, if the same thing goes up on Monday, then you make more profits. But if the premium, if the stock is going down for 1 or 2 days and again coming back, again going down, again coming up, then you are losing the time. You have less time now. You bought a 19th August contract and your stock is not immediately moving on Monday or Tuesday or Wednesday. Then every day you are losing some value from your premium. As I told you initially, you are paying a premium for different things. You are paying for time value, you are paying for implied volatility, you are also paying for the price. So price we already discussed about delta and gamma. Theta is for the time decay. If it increases on the same day, you make more profits. But if it takes 5 days for the stock to move from 110 to 115, you will make less money. That means every day, if you are buying on Monday, then you have a theta of minus 28 cents, right? Let us say if you're buying a 115 call, then every day your premium will go down by 23 cents. That means if your investment is $130, $23 from that you will be losing. So that's why, for example, after exactly on Friday, it is moving to 112 or 113. Right? When the stock is at 110, you bought it. But the stock did not move on Monday, Tuesday, Wednesday, Thursday, and finally on Friday, it might move to 112. Then you will be feeling, right? I got it 110, now stock moved to 112, I should be in profit. But whatever you paid, all those premiums are eaten by your theta, your time decay. Right? Out of this money, whatever you paid, every day you are losing 20 cents, 21 cents. So even though stock might have moved 5 days, 520s, nearly $1 is gone. You don't have much money sitting there. Even though stock might move up, but if it is taking a lot of time, you will not make profit. So is also, again, if you see, if you go with the in the money, you have very low theta. You are not paying, or you are paying only 13 cents, 16 cents, 18 cents. Whereas at the money, generally it will be high. Again, if you go out of the money, because the possibility of stock moving to 120 is only 12%. So you have a less theta here. The stock moving to 115 is approximately 29%. You have nearly 23 cents theta. Every day you are losing 23 cents from your premium, whatever you paid. If you paid $133, you are losing $23 on each and every day. So that is called theta. It is also because especially, right, if you are buying lotto trades, right? If you see the next slide, you will understand. And decay is not linear, right? It is not on first day you will have 23 cents, second day you will have 23 cents, third day you will have 23 cents. It is not like that. Generally, when the option contract is far away, your theta will be very small, right? That's why if market is generally stable, we generally go with some 4 weeks or 6 weeks or 8 weeks expiries. Because market is so choppy, market is so volatile, there are a lot of news driven market, we are generally going with the next week contracts, right? But the problem with that is, if you have more time, your theta will be very small initially. But if it is closer, right? If it is only 1 week expiry, or if it is only 2 days expiry, 3 days expiry, the theta will be very huge. If you have 23 gamma or 23 theta here for 115 call, on Monday you may lose only 10 cents from the theta. On Tuesday you may lose 15 cents. On Wednesday you may lose 17 cents. Like that, it keeps on going more and more higher as the expiry date gets closer. So that's why your lotos are very, very dangerous, right? If the stock is not moving, your option premiums will become zero very quickly because it is close to the expiry. If the stock moves up, your delta, your gamma, everything helps you. But if stock doesn't move, your theta will kill your option premium, and it will quickly make it zero. On the same day, you have expiry. So that's why lotto trades are very, very risky. Unless you have that high risk tolerance to take it to zero, then all right, you are okay with that premiums, your theta killing all your premiums, then only you go with those lotto trades, the same day trades. If you are not comfortable, you always better go with next week or 2 weeks after. If you have a low risk tolerance, you better go with the trades after a week or two. or right again, when market is there better, then always better to go with not even the current month expiry, the next month expiry or so. Right? That is about theta, which is time decay based on every day you are losing value of your premium. That's why even stock moves up, but if it moves up after 4 or 5 days, you may not make much profit. If it moves on the same day, you see a stock, suddenly on the same day it moves from 110 to 115, your premiums might become 100%. But if the same stock takes 4 to 5 days to move from 110 to 115, you will make less profits, or you may not even make any profits, because all whatever you paid, if you are especially in the out of money, because you don't have intrinsic value, everything you paid is for extrinsic value. You paid for volatility, you paid for the option for the time value. So all your premium can become zero. Even though stock price might move, you may not make money. So that's what you all need to understand based on your risk tolerance, whether you want to go with a same day trades or you want to take it, right? So that's why sometimes when Casey is giving some trades, he won't mention the expiry. So it is up to you. If you have a high risk tolerance, you can take the same week expiry. If you have a low risk tolerance, for same premium, you can take the next week. So your theta will be slow. You make less profits if the stock moves. If it is the same week, and if stock moves immediately, then your delta, your gamma will help the stock to move quickly. Now your option premiums to move quickly. But if it is not moving, then your theta will eat all your premiums. So that's why it is up to you based on your risk. You have to decide, I am okay for lower profits. Then maybe next week expiry, instead of taking 19th August, you can take 26th August 115 call. You have a lower theta in the next week. So even though stock is taking more time to move, it will, you have more time, you have less theta in the next week, and you can make lower profits, but you have a lower risk. So that is also very, very important for you to all understand that based on the theta, you have, as time goes, right, as you lose time, your premiums will keep going down and down. Those lotto trades are very, very risky. Unless you are okay to lose, unless you have a high risk tolerance, never go with the lotto trades. Right? Wherever there is a high risk, you can make high money, but you should be ready to take the risk. Only if you are ready to take the risk, you have to take the lotto trades. Otherwise, don't even go towards them, because if the stock doesn't move, then the entire premium will quickly become zero. Within 1 to 2 hours on a Friday, the theta will eat away all your premiums, whatever you paid, right? You can see the graph, number of days left to be, right? If it is 49 days, then it will be very, very slow. As it comes, immediately the entire premium will be eaten away. It is not linear that on day 1, 10% expiry, it won't go like 10%, 10%, 10%. It may start with 1%, 2%, 3%. Suddenly on last day, it may eat our entire 20, 25%. Right? And then we have Vega, just like based on the time, how your premiums get changed based on the volatility. If the stock is moving up and down, if there is high volatility, your Vega will help you. Again, you have Vega here. If it is a high volatility, for every, as the volatility increases, you will be making additional 5 cents for that particular strike price. So these are the, right, mainly delta, gamma, theta. These are the 3 things. Again, you have Vega, you have other things which are not, right, that quite important compared to delta, gamma, theta. But basically delta and gamma are for the price, theta is for the time decay, Vega is for the implied volatility, how your premiums are impacted. If things move up, if stock price moves up, your delta and gamma will help you to increase your price. If you lose time, the theta will eat away your premiums. If the stock moves up, the high volatility, your Vega will help you to increase the premiums. If the volatility is decreasing, your premiums will get decreased. Like that, basically, right? All these understanding these option Greeks will help you to uh, right. One is here you can see, oh, delta is between this and this, and a lot of people are going for out of the money. That means there is a high potential for this one. Or based on your account size, even though analyst might be giving a 115 call, if you have a high risk tolerance, you have a bigger account, you can go with a high delta, high gamma, with a low theta, so that if stock moves up, you make a lot of money, lot of profits. For the same investment, you will make 90% profit here, you will make only 30% profit here. Because your increase in every dollar, you make only 29 cents or 29% profit. For the same 110 to 115, if you are buying this one, you make 90% of the profit. Right? Then there are a few more tickers which I want to show you. Then you have, let's see. Again, SDC. Right? SDC is a meme stock. It generally, whenever it starts moving, it moves so high. So there is a high risk with the SDC compared to AMAT. But right, again, on 5 minutes and 30 minutes, it is looking good. There is a lot of if you see the news, again, you have Wall Street bets. They are talking about this SDC stock. There is a lot of short squeeze happening, right? That BBBY, Bed Bath Beyond, is a good meme stock. It moved so, right? Option premiums gave nearly 1000%. It went up so high. In the same way, AMC, right? GameStop, all these are meme stocks. SDC is one of them. And there is a lot of this top Wall Street bets mentioned for Thursday about SDC. 10 stocks trending on Discord. So there is some news. It already moved from 1.2, right? If you see, right, nearly from on 11th, on Thursday, it started moving from $1.2 to nearly it moved to 1.8, and then it came down little. Again, it went to 1.8. But there is a potential it can move over $2 plus. Then we also discussed about what are the other ones. So one is SDC, yeah, then CPNG, right? Definitely this looks very, very good. So CPNG is another stock. So if you see on 30 minutes, it is in uptrend. It is going up, getting close. It is near the support. And you have a big resistance here at 21.37. From 18.7 to 21, you have a high potential. And if you see on 5 minutes, that means for day trading and scalping, it is above the cloud. It is in the buy range. Right, from technical side, it is looking very, very good. Right, from technical aspect. And then if you see CPNG, right, again, there is a lot of good news, right? This on 8/11, Mizuho Securities raises coupon price target to $22 from $18, maintains neutral rating. And then why Disney is higher by more than 7%. These are the 40 stocks moving. The MW coupon stock price raised it to $22 from $18. This is another analyst. And UBS adjusts coupon price target to $25 from $19. Maintains buy rating. Right? And then let us look at open interest and other things. If you see, right, you compare both calls and puts. If you see there is a huge open interest at 22.5 price. Then you have a huge interest at $20 price. Right? Compared to on the put side, you can see a lot of interest on the call side. There is a lot of liquidity. There is a lot of volume. So, right, you can take 20 call or 22.5 call on Monday. If there is no bad news or anything, then there is a potential that this stock can, because it is looking right bullish from the technical perspective. There is a lot of good news here. There is a lot of open volume here. Then let us look at, right, if you see 17 call, 999 quantity, 1.95, right? There is some puts, but it is only 36 cents as a hedge. Somebody did 1.95 for nearly $1,000 quantity. Somebody invested huge. And if you see the overall, and then if you see the option statistics, 19,835 calls, 11,349 puts. How much percentage? Below 50, nearly 50, more than 50%. They invested the right delta less than 50. That means people are expecting that the stock will move huge. So again, right, you have a lot of factors with option flow, fundamentals, technicals, everything is with the open interest and volume, everything is showing that this CPNG can move well Monday, Tuesday. So I will try to get in a 20 call or 22.5 call, or right, as we discussed, if you have a big account, if you have a huge, then I can also, right, if I buy a 14 call, I will make 96 cents for every dollar move. If stock moves from 18 to 22, my premiums will go by add by another $4 if I have a high risk tolerance, or 95 cents, 93 cents, 92 cents. So I can also look what is the open interest. So if you see 17.5, there is a huge open interest. At 15, there is a huge open interest. Right? This looks good, right? This 17.5 in the money call. Either I can buy out of the, if I have a small account, if I have a low risk tolerance, I will buy a 20 call or 22.5 call. If I have a high risk tolerance, I have a big account, I will buy 17.5 because I can make 80, nearly 79 cents on the first dollar move. On the second dollar move, 79 plus 15, 94 cents. If there is another dollar move, 79 plus 15 plus 15. And I, right, the theta is only minus 0.05. So now, right, you are connecting all the dots. When you have something to buy, you see technicals, you see fundamentals, you see option call flows, you see like what is the biggest purchase on the day, on the Friday, what is the overall volume, you see, right, what is the implied volatility, what is the VWAP, the stock is above the VWAP, what is the overall call volume, what is the overall put volume. So when you combine all these things, generally the success rate will be high and we can be in the profits, right? If we don't, if we just buy without anything, then right, without understanding, it is, we may right, with FOMO, without looking at bid and ask, we might be buy, or sometimes we buy, right, I have a small account, let me buy 23.5. What is the possibility that it will go to 23.5? It is only 4% probability. There is no option flow there. That means there is no open interest, is only 215. Right? Just investing by another few cents, if you get a 22.5, you have a higher possibility to make money. Just to save some money, if you are buying a 23.5 without understanding option Greeks or without understanding option volume or open interest, or then we may lose that entire money. It can become zero. So that's why understanding open interest, volume, understanding delta, gamma, theta, understanding about this time and sale, right? What is the sales which are happening on the day, and what is the overall statistics, for puts and calls. All these things will give us more confidence so that you can confidently enter into a trade, and even though stock goes little down, you won't get panic because a lot of factors are showing that the stock can move. Otherwise, you immediately suddenly stock goes down by 20 cents, 30 cents, you will start getting panic. You will sell it off, and then immediately it gets retraced, it goes to 20 or 21, and then you feel bad that you sold it at a loss. Right? That's why understanding these concepts, understanding, right, connecting all the dots with fundamentals, technicals, with option flow will make you a better, a confident trader and make better profits rather than just going with a fear of missing out and just trying to buy without understanding things, right? Again, as analysts, they don't know how many of their members are millionaires, how many of them may have a $5,000 account. So they try to give somewhere here, right? Maybe 20 or 21.5 or 22.5. But if you have the concepts, if you know, then you can, if you have a bigger account, you have high risk, you can make a lot more money by buying a 17 call or 17.5 call. Sorry, 17.5 call or 15 call compared to this one. So right, that's what I wanted to share today about these option Greeks and what are various factors we need to consider before we buy something or we buy calls or puts. And then, right, in the next week, we'll also discuss about debit spreads and credit spreads. That is one more way. So with calls and puts, what will happen is only if stock moves up, you make money with a call. Only if stock goes down, you will make money with a put. With spreads, you can make money in both the ways. You can buy a call, you can sell a call. Stock goes from here to this point. For example, you are selling a 23 call. You buy a 20 call. So your investment gets reduced. Your investment is only 24 minus you are getting some 3 cents here. So your investment gets reduced. You make profit here. You also make profit here. In the same way, puts also, you can buy a put, you can sell a put. So we'll be discussing about what are debit spreads, what are credit spreads, how to increase your profit chances, profit potential, so that instead of depending on only one way, you can make money in both the ways by buying and selling. So your investment gets reduced, your profit will also become right. With a low investment, you can make a lot more money. Many of us feel like if it is a spread or something, we feel like, oh, it is complex, but it is very, very easy, right? Rather than just buying a call or buying a put, you can do both the things, with which your investment gets reduced, your risk gets reduced, and you have, instead of one way to make money, you can make money in both the ways. We'll be discussing it in the next week session. Let me quickly see if you have some questions. Yeah, at the end of the day, right, today is the last day for that algo thing. Once everybody subscribes, I'll be sending links to all the annual subscribers. What happens when you don't sell before it expires? Again, right, if the stock price is, for example, you bought at 22.5 call and stock price is at 21, then nothing will happen, right? Because you don't have an obligation to buy. But if the stock price is 23 or 24 and you bought a 22.5 call, that contract will be assigned. That means you get the stocks at 22.5 into your account. Then on Monday morning, you can sell them and you can make profit. I hope you got that. Yeah, TD Ameritrade charges for option contracts. They charge 65 cents for every contract. Yeah, for the annual subscribers, I'll be sharing some indicators to see like how to analyze, how to right. Tomorrow I'll take a session for them to give them some indicators, so either they can use them on TD Ameritrade or on the trading view. Yeah, next week we'll be discussing on trail stop and stop loss. Right. Again, stop loss is based on your risk tolerance. You can right by default, because the market is so choppy. You can make 50 per right. Stocks are going down. You are seeing right. Market stock suddenly goes down by $10-20, and then again it moves up. So that's why we are not giving a stop loss, but you can put it a default of 50% if you don't want to take a high risk, right? 50% you can consider that as a default stop loss. But most of the times, that's why we are going with uh, more scalps day trades rather than swing trades in most of the cases, because the market still right, it is getting little better. Right, option price going down super quick. Again, that theta might be the reason. You might be uh, you might be buying right same day expiry or same week expiry. If you want your option price to not go down like that, you better go with the next week or next month expiry, where the theta will be very very slow, so that even though you pay little more premiums, your theta, your option premiums will not suddenly go down. Right, yeah, I discussed about the duration, which is the time decay. Uh, right, both news also definitely matter, uh, right? Because retail investors, or they buy based on the analyst upgrades, or so sometimes definitely fundamentals all right. Again, if you are doing scalping, maybe just technical analysis enough. If you are going with a swing trade, then definitely looking at news, looking at the fundamentals, looking at what is happening will help you to gain that additional confidence. But if you are just doing scalping, then suddenly you see that it broke a right, it broke a resistance and it is moving up, there is a breakout, then just using those things you can buy it. And yeah, this tool is think or swim, which is a part of TDM Trade, a free tool. Yeah, option gains will be short-term capital gains. Right, all the videos will be uploaded onto the YouTube channel. You can go to the YouTube and refer them in future. You don't need to have stocks. If you want to buy calls or puts, you don't need to have stocks in your account. Right, if you go to the right choice, uh, so right, you can see option basics, option chain, and options terminology, how to place conditional orders in think or swim. You have all the videos where you can watch how to use trail stop order, benefits of you have all the videos, a lot of videos which are related to uh, which can help you to uh, how to set up your think or swim, what are the low risk strategies with options, basic concepts in trading, Ichimoku cloud strategy. You have a lot of videos which you can watch, and right, you can fix any gaps in your knowledge. Uh, right, halt alerts, right, as I told in earlier, when stocks move so quickly within a 5-minute period, if they are moving up by 5% or up, generally those halts are applied. The trading will be paused for 5 minutes. Then we can use, right, again, you can look at the news for that halt. And if you think there is still upward movement, generally, if you look at the first halt, there might be some more upward movement. If you are already looking at the 6th or 7th halt, then there might be downward movement from there. So you can either short the stocks or you can buy the stocks, but it comes with risk. So if you are new to trading, I don't suggest you to take the halts. If you have experience, then you can immediately see, for example, BBBY. If there is a halt, the first halt, then you can assume that it will still go further high. But if it is completely some new stock, new IPO, it might go up or it might also come down. So if you are experienced trader, those halts will help you to either short the stocks and make money, or to buy them in the first halt and make some money. You have to be quick to scalp with a tight stop loss. Then those will be helpful. Yeah, we'll be doing more trading sessions. Definitely Thinkorswim is a better platform compared to IBKR for option trading, for better price and better volume flow. You don't need, you can sell option at any price. You don't need them to go beyond the break-even price, or go beyond the strike price. Even though suddenly it moves by $1 also, you can take off some contracts, get back your capital, and then you can play with your free option contracts. Yeah, we'll do some sessions on TDM retrade also. So if strike price hits before the last day of the week, either if you want, you can take the assignment. You don't need to wait until Friday or Saturday for the assignment, or already your premiums might be very high and you can sell the contracts and you can make money. Right, yeah, I'll do a separate session on stop loss, trail stop loss, how to set with the percentages, all those things, because I have another appointment now. But yeah, thanks everyone. Hope you learned some concepts, you understood some terms, and you understood like why this delta, gamma, theta, they are very, very important to understand. And so that, you basically treat analyst alert as a direction, whether bullish direction or bearish direction. And then with the knowledge, you can also take whichever, you can take in the money calls, you can take based on the open interest, volume, and all those things. You can take your decisions also, because they try to give something which for an average subscriber with a small account. But if you have a big account, if you have a big risk tolerance, you want to make more profits, and you can definitely go with in the money or at the money, or based on, once you understand, you can take your own decisions, that's how we become successful. Create your own rules, create your own strategies, use the alerts as a support, as a catalyst. But once you make your own, based on your risk tolerance, you can have stop loss at 10%, 20, 50, it is up to you. If you take more risk, you can make more money or you can lose more money. So it depends on your risk tolerance levels. Right? Yeah. Thanks everyone. Good night, and we'll talk again next week.